For TraderInsight.com, I'm Adrian Manz. We're back to do another lesson. This time around, it's how to turn a good trade into a great trade. Let's just dive right into today's lesson. What do most traders say? They're going to tell you, let your profits run and cut your losses short. But what do most traders do? They cut their profits short and let their losses run. Why does it happen? Pretty basic human psychology. Psychological comfort is what this is all about. Loss equals failure, so we want to avoid it. And profit equals success, so we take it. As time goes on, traders who fall into this trap can let those losses get bigger and bigger and bigger, always thinking they're going to turn around and turn into good trades, and they take their profits out of the market very early because they're afraid they're going to turn into losses. So they want to get that feeling of success as quickly as they can. So what's the solution? It's pretty simple. I think I've been preaching this for a long time. Find identifiable pattern setups, identify logical support and resistance areas, identify logical targets and stop losses based on those support and resistance zones. If you're going to use a stop loss on a trade and you're going to say, well, I can afford to lose $500, so I'm going to use a 50-cent per share stop because I always like to trade 1,000 shares, I'm going to guarantee you're going to lose money. You're going to be out of business practically before you get into business because the market doesn't care one bit what you can afford to lose. Once you have a trading plan put together, plan the trade, trade the plan, make sure you've got an objective way of measuring what's going on, and redefine what you think is success. Measure your success not by whether or not you made money, but whether or not you executed your trading plan exactly the way you said you were going to. And then finally, once you have a profit in your pocket, rather than looking to snatch it off the table, use some real solid logic and trailing stops based on price to take those trades, those good trades, and turn them into great ones, right? So once the trade starts moving in your favor and it's beyond the initial target, look at the trade and say, is there a reason to assume that we're going to have another move that might take me further into the green? Those of you on the Around the Horn trading plan, you're going to recognize this right away. If this is my trading plan, exactly the way that it sits on the desk in front of me, this is just one stock from one day of the trading service. It pretty much is going to exemplify exactly what I think is important in putting together your plan, and then we're going to talk about how the trade itself was carried out in the room. So obviously, as I said, I'm looking for recognizable and consistent patterns. This is an infield fly setup. Those of you who know Around the Horn backwards and forward, you know that that's one of the patterns that I make my living with. It's one of the patterns in the book. Then we plan an entry, identify potential inflection points, set an initial target, and set the initial stop. So let's have a look at how this thing is put together. First off, we know that it's Mohawk. We know it's an infield fly short side setup with a 47.31 entry, a 47.62 stop, and a 46.92 initial target. That gives us a 1 1/4 to 1 ratio in the trade, risk-reward ratio. And we see that 50% of the target is 47.12. Once the trade is moving in my direction, if I get to $47.12, I'm going to move my stop to break even. So in this case, the stop would be moved to $47.31, while the initial target would still be maintained at $46.92. Then we also see here that I've identified the inflection points that I'm expecting the market to move through. Got all these support and resistance areas. Those are floor trader pivots. Since this is a short trade, I will be interested mostly in support 1 and support 2. Those are on the way to my target, and one of them is just a little bit beyond the target. I just have to be aware that those are there. We're in the business of predicting inflection points, so we always have to keep those in the back of our mind. We know that the stock is very likely going to pause when it gets to these levels, and pretty much just want to be aware of them so that there's no reason to think something is wrong with the trade. Now, for those of you who are on the trading plan only, who don't participate in the war room for one reason or another, you don't know yet, but MHK we wound up getting about $1, well, over $1 out of on the session, even though the target in the trading plan was much smaller, so you won't be seeing that data until the end of the month when we look at the summaries. Those of you in the war room, of course, you were there when this happened live. But let's talk quickly about the trade. Here we see that the infield fly setup was there for us. We knew exactly what we were looking for. We know that we had a target down at these support and resistance highs. Now, if you look back on the chart, you can see those highs there, a represented place that price stopped very frequently on the way up, as well as on the way back down again when it was moving lower over the past year or so. So this was a very logical place to put our initial target. Here's a snapshot of the war room. First thing in the morning, we had 13 stocks up. Obviously, that was everything on the Around the Horn trading plan, the stocks to watch list, and the radar list, everything on the service. And we see that Dave and I were talking pretty early on in the MHK trade about the fact that it looked like we were probably going to get an extension if we got through the S2 level. And by the time that the trade was about a half an hour old, I had 46.28 as a trailing stop for the balance of the position. I had quite a few people email me asking me, what's that all about? And what do you use as a criterion for moving a trailing stop? So I thought it'd make a good lesson. So how do you manage these things? Well, we see here this is the MHK entry. We got in right at the stated entry price. Stock got down to the initial target. Those of you who used automated exits or who tend to use automated exits, this is why I tell you not to do that. It's better to sit there and just watch these things and see if you can't get an extension on them. Obviously, we got out with about $1 in profit in the room. Wound up being a really good trade. And what I want to look at is very briefly just how to go through and place those trailing stops on the way down, because here on this 5-minute chart it's not real obvious, right? It looks like there's support and resistance, but it might be a little bit difficult to figure out whether or not they're significant enough to warrant a trailing stop. So the tool that Julie and I use to trail stops is called a 25 tick chart. We take the time compression factor out of a chart and we just look at pure price. 25 ticks on a ticker tape represents each one of these bars. It gives us a different way of looking at things. We overlay this with those 5-minute data points, and voila, you wind up with a chart that has a little bit more meaning and depth. We see that we had the entry, followed by that move to the initial profit target, and then we see these plateaus. Usually I'm looking for 3 to 4 bars of price support and resistance as a place to rest a stop when a profit is extending for me. So each time that price is moving more and more in my favor, I'm going and dropping my trailing stop to these areas that I've identified as being significant support and resistance. So we see that that keeps us in the trade until we get a violation of this final support and resistance area that I've identified here, and we get taken out at the red arrow. So that was where we called the exit on the trade in the room, and made for a very, very nice extension. So nothing wrong with just trading the plan the way that it is, as long as I'm sticking to my guns and replicating the performance of the trading plan every day. That's cool. But really what I want to do is use that 25 tick data, overlay it with some 5-minute data, find logical support and resistance points when a trade goes in my favor, and that will help me then turn a good one into a great one. If you're interested in my methodology, the title of my book is Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. It's a bestseller. It contains all the patterns I've traded for the past 12 years, clear explanations of how and why each one works, and it fosters a methodology that teaches you to put together a trading plan and to learn by doing. It's available for just about the best price anywhere at TraderInsight.com. It's also available at Barnes & Noble, Amazon.com, Windsor Books, Traders Library, Traders Press, just about anywhere that fine books are sold. Also, if you're interested in the war room that I talked about earlier, it's live intraday audio analysis. We also have a text-based chat that goes along with it. Gives all the entries, targets, stops that we have for all the trades that we're in over the course of the day. Most importantly, we trade the same setups at the same levels with our own money. I hope you found this video useful. For TraderInsight.com, I'm Adrian Manz. This was Turning Good Trades into Great Trades.